All right. Well, we are counting down to the pre-open session. 3 minutes away. Anuj is here with how he's seeing the trading setup. SGX is absolutely flat. Anuj, what are you watching?
Yeah, Prashant, today the cues are coming from the global screen because most of the poll outcome is priced in by the market now completely, and in that I think Nasdaq is showing signs of entering fresh correction. So I think that is something which is clearly something you've got to keep an eye on. Also keep in mind that China is opening up to FDI, and normally you see a bit of an algo trade. Today Chinese markets are doing very well. So while metals may do well, overall that's negative for India from the algo trade point of view. But the market's focus is now on next week's FOMC meet, because your visibility of terminal rate may have got disturbed a bit because of the data points of the last couple of weeks or so. And it's possible that the Nifty tests the 20-day exponential moving average. Yesterday, the Nifty closed below the 10-day exponential moving average after taking support on it for 2 days. So just in the near term, expiry today, the market's texture may well be sell on rally. Of course, the 20-day exponential moving average comes in at 18,440. It's possible that you test that in this run. On the Bank Nifty, it's a relatively stronger index. It's still defending its 10-day exponential moving average of 43,040. If that breaches, then the 20-day exponential moving average is placed at 42,627. But right now, it's a bit of a no-trade zone on the Bank Nifty. It's got a broader range of 42,800 to 43,300. And the stock I'll keep an eye on is HDFC Bank. Normally makes a move on Thursday, especially at 3 p.m. So that's something to keep an eye on.
Okay, all right, Anuj, thanks a lot for that. Well, we have Ashish Chaturmutta, Director, Head Research at JM Financial as well, who joins in. Hi, Ashish, morning. Run us through your derivative strategies.
Good morning, Nigel. So I think, broadly markets have seen a 5-day correction, and typically in a bull market, a good 4-5-day correction with a very low volume activity is a clear, strategy to go buy on dips. And I think index is still trading about 20-day moving average, as Anuj was mentioning, and that's around 18,450. So till the time we don't see a breach below 18,450 on a closing basis, I think it's a buy on dip kind of strategies we are going to adopt. In terms of individual stocks, I think banking is showing a very strong traction. There we are witnessing strong OI buildup, particularly into the PSU banks and specifically into stocks like Axis Bank and HDFC Bank. So the top pick in the private banking basket would be Axis Bank. There I think one can initiate a long with around stop loss around 900 levels. On upside, stock is poised for a fresh all-time high towards 950, 955 trajectory. So Axis would be my top pick in the private banking basket at current levels. Bank of Baroda has given a fresh breakout on the weekly and monthly chart frames, and we have seen a very strong build-up of long positions in stocks like Bank of Baroda, Canara Bank and PNB. So I think Bank of Baroda looks quite promising, keeping 172 as a trading stop loss. 185 would be my short-term target in Bank of Baroda. In the capital goods space, Larsen & Toubro is looking very promising. Here one can initiate a long, keeping 2090 as a trading stop loss. One can initiate a long on upside. 2250, 2300 would be my short-term target in Larsen & Toubro. And to play the falling crude, I think the entire Asian Paints, Berger and Pidilite set of stocks are looking quite strong. So within that, Pidilite is giving a fresh breakout, keeping 2730 as a trading stop loss. One can look for 2860, 2890 as an immediate upside in Pidilite Industries.
Ashish, thank you very much for that. Let's get to our momentumizer for the day. Sonal is back with us. What do you have?
Well, I have fact on my radar today, Reema, because the stock has been buzzing off late. Yesterday, it closed higher by 10% and is just 2% away from its 52-week high mark. And this stock is up 23% year to date as well. Well, fertilizer stocks have been seeing some momentum lately. And yesterday, the volumes for this particular stock was around 4 times higher than the average volumes that we see the stock trading at. And at these levels, the stock is comfortably above the 20-day moving average, 50, 100 and 200-day moving average as well. So some momentum seen here. Yesterday's turnover on NSE was around 128 crore rupees, which is actually equal to the turnover seen in the last 9 trading days as well. So yesterday there was a lot of buying seen in this particular stock. Well, we are seeing prices for fertilizers in the country rising, and that is one of the reasons why these stocks are excited. And the second thing is that experts are of the opinion that fertilizer demand in the coming season will be very strong. Not only fact, yesterday we saw Madras fertilizers high by 5.5%, RCF up by 5%, National Fertilizers up around 2%. So there was momentum in this particular space, and fact was one of the biggest outperformers yesterday.
Sonal, thank you very much for that. Yesterday, we had the RBI governor also saying that the agriculture sector remains resilient. Rabi season sowing has started off on a very good note. Prakash Diwan is still with us.
Just a minute.
Yeah.
You look at the rupee. It's a 50 paise move, right? I mean, that's a very large move coming in, almost 0.75% on the rupee against the dollar. Okay, 82.32, and the close was 74.74 or so. So that's what we are seeing right now in terms of, but that's a large move. I mean, yesterday also, I think by close we saw a big reversal, and the dollar rupee fell. I mean, which is the dollar strengthened, and today we got this, which is a little bit more in favor of the rupee, which is coming.
The close yesterday was 82.47.
So I think so this is correct then, because I think the flash said 74. But yeah, so it doesn't account for the last recovery, the late recovery that I was talking about. We saw a very sharp surge in the rupee against the dollar. 3 days prior to that, we almost had 150 paise depreciation. But yesterday and how we've started, I mean, there is a bit of a pushback which is coming through. Go on, Reem.
Absolutely. That's also weighing on India's current account deficit. Yesterday, we had JSW Steel also telling us, because global demand is so weak and domestic demand is so strong, imports have increased. Imports of steel have increased substantially in India. I think it's up 22 million tons. That's the figure that he gave for so far 2022. And that's also one of the factors which is driving this current account deficit and the concerns that have risen on the back of that. But Prakash Diwan is still with us. Prakash, Sonal was telling us how technically FACT and the rest of the fertilizer pack have started seeing traction. They're rising on very large volumes. And even fundamentally, she indicated that fertilizer demand appears to be strong because Rabi, the sowing, has started off on a good note. Prices are inching up. Is this a space that looks attractive, tactically at least?
Absolutely. It is only tactical at this point in time, Reema, because, there's always this risk of some sort of a regulatory change that happens, and that probably puts a lid on, the kind of growth particularly in terms of profitability for some of these companies. And, unfortunately, most of these companies have not been able to upgrade their capacities in terms of modernization. So what's happening is suddenly there's this pressure to produce more, because a lot of the global fertilizer setup complex has been disturbed by the Chinese disruption. There's not much coming from there, but Europe continues to be very demanding in terms of that growth, and then that's exactly why global prices are indicating that it will percolate to some sort of a price push here as well. And the last quarterly GDP growth that we saw, agri was the only pocket which actually showed growth, which means that there has been some ability to pass on prices to end consumers here, and that's what's reflected in food inflation as well. So given all that, there is a very strong case. FACT again is one of those favored ones because it's undervalued from a fertilizer production perspective, and also a lot of other chemicals like caprolactam and also. But I like GSFC out here. It's a bit complex in terms of the mix that it has. It has fertilizer. It has a lot of shareholding in some of the other Gujarat-based companies, and of course it has its own production capacity on non-fertilizer chemicals, which is very, very strong. So given that, I think you'll probably be much more safer off from an allocation perspective. But I think the entire fertilizer space, Reema, is going to continue to see re-rating for at least the next 4 months till the budget, hoping things look up and positively continue to look up.
Okay, all right, Prakash, thanks so much for stopping by and running us through your view on a whole host of stocks. And I'm going to speak to you later with regard to the December plans. We could do something since
look forward to that.
All right. Okay, Prakash, thanks so much. Well, let's move on then. Renu Baid, Vice President Research at IIFL Institutional Equities, joins us to discuss the buzzing space. That's the CAPEX theme, capital goods space. Hi, Renu. Good morning. Thanks so much for joining in. Well, yesterday the stock that outperformed was Siemens. They won that large order, and the street likes it quite a bit. What's your read-through with regard to this large order that they did win, and your view on Siemens at these valuations?
Sure. I think this is first of its type of public-private partnership order for rolling stocks from Indian Railways. And this is just the start on the locomotive side for 9,000 HP. Followed by this, we will have similar large or even orders larger than this for Vande Bharat train sets, as well as for 12,000 HP locos. So this is just the beginning. It's positive that activities have started moving in terms of electrical equipment supplies for railways. Coming on to Siemens winning this order, from a costing perspective, it was expected that Siemens would be better placed compared to its peer Alstom, who was the bidder. But what is more surprising is the price at which it has won. The price is almost 40 to 50% lower than the benchmark price, which Indian Railways had put across as the estimate. So an average loco price of 10 crores or less than that is definitely very aggressive, given that there were only two bidders. So we'll have to see what are the management comments in terms of how will they make money on this order. Nonetheless, 13,000 crores kind of order executable over 11 years with a 35-year AMC contract is definitely attractive and will help to improve the visibility for the mobility segment in Siemens, which is just barely 10% today. So this has been one of the key growth drivers for Siemens in the current fiscal year. And we think mobility will spearhead going forward in the next 12-18 months as well. So our view on Siemens is the order is positive in terms of improving growth visibility, but profitability in our view, based on the inputs that we have as on today, is extremely shaky on this project. So we need to see how Siemens will pull through in terms of margins on this over the next 5 to 7 years, while the capex has been fairly supportive. So we have had an ad recommendation on the stock with a target price of close to in terms 3,200 rupees. So we'll have to. Stock has done well. It is a good play on the diversified industrial capex. But I think this order is a green shoot and a signal that large project awards from government sector for electrical rolling stocks have kickstarted, and this is just the beginning. But I don't see any reason why companies need to be really aggressive when competition is thin on the pricing side.
Renu, hi, good morning. You know, are we starting to? I saw, I think this was CMI data which said that private sort of capex is. And feel free to correct me if I'm wrong, because the numbers are large. They've finally gotten through the 6 lakh crore threshold. Overall investments, I think. I don't know if you've looked at that data. After many years, are we starting to finally get through with this long-awaited capex revival cycle on the private sector?
Yes, I think the CMI data also gives you some of the data points with a lag. That is a reflection of the investments now being supported by private sector as well, which was fairly muted over the last 5 to 6 years. So while government investments were there, private sector investments started to pick up, I would say, post-pandemic, the second wave itself. We had started seeing accretion in order inflows for most companies in the last fiscal year or the last 4 quarters. And it's now that the execution has started to pick up, the CMI numbers in terms of project implementations have been reflecting. So we as a house have been positive on the capex and the cyclical space. We think it's somewhere close to second year in terms of these orders coming through. And orders is always a lead indicator in terms of investment pickup. And I think it's been almost 4 quarters of the strength holding across mid and short cycle projects as well as large cycle orders which have been there in pipeline. So I don't see any doubt on the capex cycle recovery, and at least there should be 2 to 3 years of leg to this if it's well supported by investments in minerals and metals and government investments continuing on that side.
So you're expecting the order cycle to remain robust for the next 2 to 3 years at least. But just tell us, historically, in a pre-election year, that's next year for us, what happens in terms of a pickup in government spend as well as capex? Any numbers that you could help us with?
Probably I don't have the numbers immediately handy, but anecdotally, whenever we have seen for any government, whether it's state or even more so the central government, 12-18 months ahead of the elections, the clear focus is on completing the mandates, especially on infra and large EPC construction projects. There are 2 things which happen. There is very strong cash flows across the existing projects so that projects are completed on time, which means the execution momentum for companies with backlog, with government focus and completed projects or projects which are fully funded and all clearances will see an acceleration. Second, large projects on which the governments have been working, they tend to come ahead in terms of a project award cycle. So ordering cycle also tends to accelerate before the code of conduct comes into the picture. So which is where we think that as we're heading towards elections in 2024 mid, CY23 would be a big year in terms of order inflow acceleration in various sectors, be it defense, infrastructure, where a lot of work has been done, but project awards were delayed for whatever reason. So there will be acceleration there. And the government fund flows in terms of tax collections, GST collections have been fairly healthy. So we don't see any pushback on this side. Second, the execution for all the companies, whether it's infra, EPC, construction, or cap goods, driven by the government sector, will see a significant acceleration.
Okay, all right, Renu, a little short on time, but thanks so much for stopping by and giving us your views. Look forward to chatting up with you rather soon. Well, for the time being, though, let's get Mitesh back on the show. Mitesh, what's your 9-10 call?
Nigel, I'll go with a buy on Asian Paints. Keep the stop below 3,200 and look for targets of around 3,290.
Okay, all right. Thanks, Mitesh, for that. By the way, Gujarat election results coming in. Gujarat Chief Minister Bhupendra Patel, he has won. I don't think any surprises out there, but good news coming in. Well, let's hop across to Nimesh. He's standing by to tell us about that special segment, Standout Brokerage Reports. Nimesh, what are you picking up today?
Sorry, Nigel, I missed your voice. Okay, so today's standout is on PSU Bank. Again, a PSU Bank, and it looks like the upgrades on PSU banks have started pouring in. A few days back we had Morgan Stanley, and today Credit Suisse has gone ahead and upgraded Bank of India to outperform from underperform, and they've raised the target price to 105 versus 42 earlier. Already the stock is above 90 levels, so still a 15-16% upside from current levels. Credit Suisse has raised the EPS as well by 5 to 20%. Now they believe that Bank of India has seen an improvement in profitability with PPOP ROA up to 1.7%. Even the NIMs have improved by almost 40 basis points quarter on quarter, and they expect further improvement in NIMs by more than 50 basis points by FY24 versus FY22, and they expect the ROEs to improve to 10%. So even in terms of valuation, it's still trading at less than 0.7 times FY24 estimated price to book. So valuation, there is a valuation comfort as well. So that's on Bank of India. They've also raised target price on SBI to 730 now. And on Bank of India, they've raised the target price to 220. So across the board, Credit Suisse has raised the multiples and target price on PSU bank stocks, but they've upgraded Bank of India to outperform now from underperform, and target price raised to 105.
Thank you very much for that. JP Morgan has written on TCS and L&T Technologies. So TCS note comes after they met with the CFO as well as the investor relations head. And the key takeaways are clients are cautious about next year's budget. They expect Q3, the December quarter, to have normal seasonality. As of now, there is nothing extraordinary or higher than usual. The mortgage segment remains weak. The impact of high-tech layoffs, the layoffs that we're seeing in the technology sector, is likely to come through with a lag. Right now, travel, hospitality, CPG, that's consumer packaged goods, is doing very well. Europe, UK clients are a little more cautious than what's happening in the US. US still continues to remain fairly robust, and they appear to be fairly sanguine on margins because they are saying that improving utilizations, price increases, cost optimization are all margin levers. Interesting note on L&T Technology, where they're saying that, okay, we'll talk about it in just a bit. But that's the opening take.
Well, that's right. The initial rates are coming in there. And the Nifty, well, it's opened up as flat as can be. Good to see, at least in the first tick, the number of stocks that are advancing are way more than the number of stocks that are declining. But that'll be a key montrable because the last few days, well, it gave back a little bit. What's doing well? Eicher Motors, Rima told us they are expanding in the international market. So that's opened up the gain of around 0.8%. Adani Enterprises holding with some mild green. And ICICI Bank from the frontline names, well, they has opened in the green as well. SBI Life, well, that stock is down close to around 1% from the Nifty gain, Nifty losers itself. And Kotak Mahindra Bank as well is down close to around 1%. Moving to the F&O stocks then, you have Oberoi Realty that continues a bit of a pullback that it's seen from recent lows. It's up 1.5%. Intellect Design as well has opened up with some green. On the flip side, you have BEL that's opened up with some losses, down close to around 0.7% as we speak. And GMR projects as well, airports, that's a little bit lower. As flat as can be, the Nifty start, as the SGX Nifty suggested. The mid-cap index is, well, more or less flattish, but number of stocks advancing way more than the number of stocks that are declining. What else, Rima?
Triveni is open with a cut of 4.5%. Nimesh was highlighting there is an expected block deal of nearly 7% equity, 1.7 crore shares. So there is that overhang you can see right now. It's taken place. Okay, so that block deal has taken place. There is a corporate restructuring taking place in that entire group. So Triveni Engineering has opened with a downtick. A large block deal, 11.4% equity, has changed hands early in the morning. The stock price is currently at 280 rupees. FACT, which was a momentumizer for the day, continues to be higher. This, I think, would be the third consecutive day where FACT, the fertilizer name, has opened up with strength, and RCF is another big mover. keep your eye on some of these crude beneficiaries. So whether it's paints like a Kansai, or a Berger Paints, or maybe even aviation companies, because crude prices are lower. That is the raw material for paint companies as well as aviation companies. So let's see whether there is that bit of an uptick. And Lodha, where that QIP is expected to open 3,500 crore rupees QIP, because the promoter holding stands at 82%. They have to bring it down to 75% to comply with the shareholding norms. But Lodha has opened with a cut of close to about 2.5%. Off late, Prashant, all these blocks, the supply has been getting absorbed very well in the market.
Very well, and there's more to come though. That's the only thing. And hopefully that also, without too much disruption, gets absorbed. Well, let me just quickly run you through a couple of other stocks and what they're doing. So, by the way, PSU banks, once again, that's where most of the momentum is. The public sector banks like, Union Bank, UCO Bank, Central Bank, this is the part of the market where there is continued momentum. I mean, fair bit of momentum, and this was true yesterday as well. Fact was mentioned. Yesterday you had names like RCF and Madras Fertilizer, all these names which did well. I don't think you're seeing much action there. Fact, though, is up 18% this week so far. Lodha is another one which is up 2.5%. I think we mentioned that. Reddington at about 190 is up about 2%. Metro Brands is up 1.7. It's a quieter start, let me put it that way, for the broader market universe as well. There is Imagica, which is coming up with about a 3.5% gain. That's the theme park name. So that's broadly where we are at. I mean, TCS and Kotak Bank are on the downside, including Tata Motors and Lever. Bharti is down a little bit as well. I think this is the area from where there is pressure coming through. The market dipped into the red. The Nifty was down 18 points. It's come back to being absolutely flat as of now. We're just 3 minutes into market opening. We'll get you more names in terms of what's moving around, etc. A bit from now. Our market master of the day is Mihir Vora, Director and Chief Investment Officer at Max Life Insurance. Mihir, great to have you with us here. Thank you very much for your time. So as we chug along into the end of the year, what's your sense, Samir? There is an increasing amount of chatter at the margin about this Chinese reopening and what that may mean in terms of competition for India, in terms of flows, and generally, I mean, this entire China plus one. Will that plus one exist if China continues to reopen and focus on the economy in the same way it has been over the last 1 week or so, faster than anyone expected? Your sense, Samir?
Hi, good morning. Always a pleasure. Yes, that can be a factor, but I don't think that can change things structurally as far as investors' view on the Chinese political situation in the long term, is what it is. So the flows to India that we've been seeing are a pro-India flow, not necessarily anti-China flow. I think incremental exposure to India will only increase in the FII's portfolios. And if we have some, rebalancing of the index in terms of some of the markets like, say, Korea or Taiwan being classified as developed markets, but they should be, ideally speaking, then you can continue to see the weightage of India going up. So I don't think it will make much of a difference, even in the short term, definitely not in the long term, as far as China versus India flows are concerned.
Good morning, Rima here. The street is still divided. What happens to Indian IT? Next year? Some are saying that this is a good opportunity. It's a good time now to hunt for opportunities in the Indian IT space. They've fallen a fair amount. There are signs of some nascent recovery in the global market, but there are others who are not convinced and believe there could be another leg of correction led by Nasdaq in the global market. Where do you stand, and if you could tell us the reason for that?
Hi, good morning, Rima. See, my view as a local investor, my view is that as a local investor, I need to consider the portfolio. And when I look at the portfolio of stocks and sectors that I want to own, it probably is more now tilted towards the domestic side. On one hand, we've seen the best of IT spending by the US and European companies in the post-COVID phase of 2020-21, where there was a necessity to go online, shopping, logistics, work from home. That was a bunched up kind of spending, the likes of which we are unlikely to see at least for the next 3 to 5 years. So this bunching up of spending will also lead to a kind of what you can say hangover of lesser spending going forward. So to that extent, I'm not that bullish on IT services. Maybe it will go back to that original level of 10-12% growth. Definitely not the 15-25% growth that we saw in the last couple of years. On the other hand, you have the domestic economy coming out of a slowdown because of the COVID phase. We haven't used our bullets of fiscal, etc., and we have enough space in the domestic demand to sustain. So as long as the rural economy sustains, which I hope it will, I think I'm still more focused towards domestic sectors, and that's why IT per se is less attractive to me at this point in time compared to the domestic sectors.
Hi, Mir. Good to speak to you again. Always good to hear your thoughts. Well, if you're talking about domestic themes, how do you read the past month's auto sales numbers? Some of those stocks seem to have priced in part of the good news. But I think you were constructive on that space. From here on, what are you looking at?
See, as far as passenger vehicles are concerned, I continue to be constructive. And even for commercial vehicles, because if we believe that the recovery is on its way, then definitely these segments will continue to do well. Both of these segments, commercial vehicle as well as passenger cars, are still only a tad above 2019 levels. So there's a lot of pent-up, lot of under-penetration still to kind of play out, so to say. So I wouldn't be too worried about a month's number. What should be the icing on the cake is if the rural demand picks up and we see traction in the lower ticket vehicles and two-wheelers, etc. If that happens, then we have another leg up for the auto sector.
By the way, RCF has moved up as well. RCF is up about 3%. It's the top volume traded gainer, by the way, in the market, in the broader market. GSFC is coming up about 3.6, 3.7%. So there is traction. Madras Fertilizer is up 5%. And these were some of the fertilizer names I was talking about earlier, where things are picking up a little bit. By the way, Mahir, did you participate in this entire PSU Bank rally? Apart from SBI, which for all practical purposes, I mean, it's obviously it's a PSU, but it's more sort of looked in the light of being run like a private sector lender now, at least for the last few years. But have you participated ex-SBI in this PSU rally?
So in our large cap and diversified funds, we've stuck to the top 2-3 names in the PSU space. We have some small exposure in the third, fourth names in the PSU space, but that's more in the mid cap funds.
Okay, more in the mid-cap funds. Outside of sort of PSU banks, anything else in the PSU universe? I know it's not a homogeneous kind of lot, right? I mean, different businesses, different sectors and everything. But if it were to be one, that space, the PSU space, has done very well this year. And there are companies in, we were talking about fertilizers, there's defense, there's so many others. Any thoughts there, Mahir?
Certainly. So most of our exposure has been in the defense space, and of course the couple of PSU banks that we spoke about. And as far as the energy space is concerned, whether it's oil or coal, we've been more tactical and neutral in our approach, because they are too cheap, but then there is no structural growth story. So but they happen to be part of the larger indices. So I would say on the energy PSU stocks, we are more or less neutral to underweight. On the defense PSUs, we are quite overweight. And in the banks, of course, we are playing it tactically. We're sticking to the first couple of names.
Any interesting ideas that you're exploring right now, but you haven't yet invested, but they are on your watch list?
One segment that is underweight across the board is FMCG. Of course, for valid reasons, we've not seen the rural economy do well in the last few quarters, and of course, the FMCG stocks also got hit by the higher input prices for food as well as plastics, etc., packaging materials, etc. But now we are seeing some moderation in the commodity prices and some initial very tentative signs of a rural economy coming back. So if that comes back, then you might see some interesting ideas in the FMCG space, which has been quite underweight and neglected for quite some time.
All right. Mir, you also mentioned now we need to categorize stocks that you want to own and you don't want to own. What about these new age themes? You want to own them or not?
Certainly, now that the stocks are trading at much relatively reasonable valuations, down 60-80% in some cases, there is a brand franchise, there is customer base which can be exploited, and there are some interesting opportunities that we are looking at in this space.
All right, you want to give us a little bit of a hint? There are only 4 or 5. Is it the one that is a fourth of its IPO price, or is it or is it the only profitable one out there?
So we still like profits. We still like profits. Let me say that.
We like profits. That's a nice way to put it. Mir. But even in okay, I got that. There is a lot more supply which is expected to come in. That is the general feedback that we get, right? What has been done is large, but what is perhaps coming is also going to be equally large in some of these names. Do you think it'll get that will lead to a breakdown in prices further from here, or you think the worst is behind for these names and it'll get absorbed maybe a little bit here and there, but the bottoming out process is on?
I think so, because if you look at the last 3-4 trades of blocks which have happened, they've not really happened at a discount. The stock prices had bottomed out at least a few days before the block deal. So to that extent, a lot of the negatives seem to be in the price. But then, of course, not everything is a buy. We still have to be choosy. But the negativity which was there, say, a month or a couple of months ago, is definitely something that was at its worst. And now, as I said, there are good businesses out there. There are brand franchises, some of them almost on the verge of profitability. And the ones which are not profitable also cutting costs aggressively to get back to profitability. So I think lessons well learned. But we must not underestimate the power of the brand, the power of the network effect that these companies have built from their customer base. So definitely, one should not ignore this segment.
Okay, all right, Mihir, thanks a lot for stopping by and giving us your views on a whole host of sectors as well as stocks, and giving us a bit of a hint as well. We have taken that, and let's see how things shape up. Well, let's move on then. The JK Lakshmi stock, well, that hit a fresh 52-week high earlier this week. It's nearly doubled from the lows, more than doubled, in fact, from the lows that it hit earlier this year. Checks by various brokerages like Jefferies also suggest that cement space has seen volume surge, demand come back, and input costs have cooled off. The sector has further got a boost because pet coke prices, coal prices have come down. To understand more about the sector, and particularly JK Lakshmi Cement, we're joined by Mr. Arun Shukla, the President and Director at JK Lakshmi Cement. Well, good morning, Mr. Shukla. Thanks so much for joining in. As we speak, the stock is at a fresh 52-week high, and I think this is your first media interaction, so good to speak to you. Mr. Shukla, a lot of the sell side, they're very excited by your commentary, and on ground, I believe, you're doing periodic checks with your sales force as well. You've been focusing on market share. So tell us about growth that we're looking at. For this year, that's for FY23, what kind of a growth number are you looking at? And if you want to give us a hint on the market share parameter, which market are you looking at expanding your share?
Yeah, thank you so much. Thank you for inviting me on this call. And JK Lakshmi, as you know, our footprint is there in north, west, and eastern part of our market, and we hold a sizable market share in all these markets. Our growth strategy has been profitable growth strategy. Wherever we are having sizable market share, what we call it, fair market share. And as you have seen, JK Lakshmi has progressed very well in the past few quarters, and we have been working on a lot of internal efficiency improvement, and particularly on top line part of it. When I talk of top line part, then particularly we are focusing on price positioning, our what we call GPS, geo mix, product mix, and segment mix, and obviously I think taking advantage of technology to give a differentiated experience to customer and build channel capability. So this is what we have been doing, and going forward also, this is what our strategy is, to focus on top line, improve our top line, and parallelly work on manufacturing cost and supply chain efficiency.
Okay, all right. Mr. Shukla, you have given us a sense about the focus on top line. There are only two parameters out there. One is realizations, which is not in your hands. The second one is on volumes. So what is the volume growth you're looking at? And you briefly spoke about your product mix as well. The trade sales, I understand you want to increase. To what level? And premium sales as a percentage of your sales, to what level will they move to?
So realization, I think I would say the part of this is within our control. So okay, prices we cannot control. This is something which is given. But selling the product in the right market and the right product in the right segment that is what is giving us the right kind of realization, right? So I think partially, I would say that yes, we control realization. Now coming to the volume growth, till last quarter we have grown in double digit. Our growth has been around 15% plus. And when we are going to close this year, I suppose that we are going to grow at a higher rate, higher than the industry. And we suppose we are going to have a growth of volume at around 15%.
15%, right? Growth for FY23.
Yeah.
And you also want to give us the mix, premium sales as a percentage and trade sales as a percentage. How much is it likely to be?
So I think our focus has been on improving trade sale. That is what we call, segment mix. So our plan is to take it to 60% plus, and that is what the industry average is. Typically, industry is kind of 60-40, and that is what we are trying to catch up.
Mr. Shukla, in terms of the inputs, right? We had Mr. Anil Singhvi, a cement veteran, join us earlier, who said, the worst is behind and things will keep improving. It'll perhaps take time, but it'll keep improving. Could you give us some sense of what you are saying at JK Lakshmi, and how is that going to impact profitability? Some numbers?
Yeah, so cost, I think, yes, I would definitely say that, worst is behind. And if you have seen, last few months, coal prices and petcoke prices are softening. And that is going to give us some advantage in coming quarters. Because, a lot of companies are holding on to stock, which is at a higher rate. And next quarter onward, I think is some benefit is going to come out of it. Right? If you want to put this as a percentage, then maybe I think there is some kind of softening in cost, and which is going to impact, positively by about 10 to 12%.
10 to 12% EBITDA per ton?
Yeah, around 10%. Yeah.
Okay. So can your EBITDA per ton inch up closer to, say, $700 per ton, sir? What is the number we should expect?
So right now we are at about close to 800 rupees per ton, right? And our plan is to take it to first milestone is to go to 1,000 level, and for that we do have plan. I told you that we are working on top line, and parallelly I think cost reduction in cost base. That is what is our focus area, along with the supply chain efficiency.
So when
we are
can
trying
you
to
achieve
reach to that 1,000 rupees level. Yeah.
So when can you achieve 1,000 rupees per ton EBITDA?
Our plan is to achieve this in the coming maybe around 12 to 18 months time.
In 12 to 18 months, all right. And when you're calculating your EBITDA per ton, sir, I'm thinking that you're also including the other income.
Yeah, other income is, we have, VAP product also, what we call, value-added product segment, wherein we have got RMC, AC block, and POP businesses, right?
Okay, so 200 rupee increase in the next, 12 to 18 months is what you're looking at?
Yeah, that is what I see. Yeah.
On the EBITDA per ton front. You're not yet given us that premium sales, sir. I think it was around 20% of trade sales.
Yeah, so we were at 20% last quarter. When we closed, I think we were at about 24%.
Okay.
Our plan is to take it to 30% in next 12 months time.
So this is as a percentage of trade sales, right? 24% of trade sales. Okay.
Exactly. Yeah.
Got it. Besides the industry on the whole, I just want to ask you about your expansion plans. I think on a consolidated basis, you're close to around, mid-teens, 16, 17 million tons. And you want to take it to around 30 million tons. How do you plan on doing this? Will there be some inorganic growth as well that you're looking at? Are you on the prowl as of now?
So our strategy is to really grow profitably, and this is what we have laid down our strategy of growth. Right now we are at about 15.5 million ton, and perhaps you are aware that we are putting up 2.5 million ton within our subsidiary of Udaipur Cement Works Limited. So that will take us to 18 million ton by mid of 2024. Now balance 12 million ton which we want to achieve by 2030. That is going to be combination of brownfield expansion of 6 million ton and greenfield expansion of 6 million ton. So that is what is going to take us to 30 million ton. As I said that, we want to grow profitably, and our growth plan is internal as of today. But any opportunity which comes, which adds value to our strategy and which gives, synergy to our strategic direction, definitely we are open for that also.
Do you have anything on the anvil, sir, in inorganic moves? And what is the comfortable net debt number for you?
So right now, net debt, I think EBITDA level, I think JK Lakshmi Cement is almost nil, right? And I think net debt EBITDA, something within 3 is good enough. I think this is comfortable.
Okay. Your consolidated net debt, sir, we look at it on those bases because you have Udaipur as well in there, and you're expanding capacity by around 2.5 million tons.
Yeah.
So So what is your consolidated net debt? I think the rough numbers are around 700 crores as of now.
Yes, that is what is there. Yeah, you are right.
And what is the peak debt you're looking at, given that you have expansion that's coming on stream and you'll be moving from 15.5 to 18 million ton?
Yeah, so I think that payout is going to be phased out, and in the interim will be paying our debt also, right?
Okay.
So probably I think peak debt is going to be about 12 to 1300 crore.
Okay, all right. And no plans on getting both these two entities together? We have currently two listed entities. You have
I think we do have plan. I think we are looking at a time horizon of around 3 years.
Okay.
Maybe after 3 years, these two entities are going to merge.
Your predecessor as well had told us a couple of years, but it didn't happen. So maybe by 2025, both these two entities could come together. Are we getting that correct?
That is what we see. Yeah.
All right. Well, it's been good speaking to you, Mr. Shukla. The street has given you a thumbs up from the time you have taken over in the last 3 months or so. We look forward to speaking to you here on CNBC TV18. You've given us a fair bit of details. Wishing you all the best for the remainder of this fiscal.
Thank you so much. Thank you.
Well, time to slip into a short break. Next up, we'll be joined by Abhijit Roy,